everybody. Welcome to another episode of Money Law. Today, we're going to talk about one of my favorite topics, life insurance. Yes. I know that's not most of your favorite topics, but it's my favorite topic because there are so many amazing ways life insurance can be used to protect your family, your loved ones, make sure you don't pay taxes, and deal with any kind of financial complications that you have in your life. Insurance can help solve those complications. So I have a special guest. We have Christina Mendoza from New York Life, who's here with us today, who's going to join me in educating you a little bit more about how financial life insurance can support your loved ones, your assets, and your business. Christina, hello.
Hi, Yasha. Thanks for having me.
How are you?
Doing great. Thank you.
So can you tell us a little bit of your background and what kind of got you started in this field?
Yeah, of course. So my name is Christina Mendoza. I work at the New York Life Insurance Company, a financial services professional there. Mainly, my role is pretty much education, really similar to what you do, Yasha, where I just want to make sure that I'm spreading financial literacy, the importance of what we're able to do and take care of here at the New York Life, whether it's risk management, accumulation solutions, or legacy and protection solutions moving forward in their last financial life cycle.
Thank you very much, Christina. So we both know from our own respective businesses and practice that life insurance is an amazing tool that can be used for so many things, hundreds of different strategies, and you name it. But I don't think we have the time to apply that here and educate the audience. So I'd want to talk more about a few things that I think are crucial for people to understand about life insurance. And if you don't mind, I'd like to understand a little bit more on how you can use life insurance to support your children.
Oh, actually, I'm glad you asked that, Yasha, because a majority of the people that I work with are young families with small children. Oftentimes people reach out to life insurance professionals when they bring new life into this world because now there's someone that depends on them. Also, what happens then is there are a lot of people other than just the parents who love this child. Okay. We've oftentimes heard that the grandparents tend to love their grandchildren more than they love their own children, right? Have you heard that before?
Right.
I'm pretty
sure. They
don't
have to have the responsibility of raising them, right?
It's the same thing for me and my family. I'm pretty sure my parents love my daughter more than they love me. But what happens is when people reach out for life insurance with small children, the first and foremost part is I want to make sure I protect myself as the parent. If anything were to happen to me, I'm going to make sure that my child lives a good life. That if I were to have a premature passing, my child still will be able to stay where we're living and have the same standard of living we have today, still have the ability to have money to have an education and to be taken care of by not just anybody, because we're not just going to just pay for the minimum type of childcare. We want to make sure that it's people we can trust as a safe environment for our child. And then from there, they learn that there's actually more benefits to getting life insurance, different types of life insurance plans, to be able to also save money for the children so that as they go through milestones in life, they can actually start taking an income from their policies.
Interesting. So how does that work exactly? Is this the kids are earning an income on the policy while the parents are still alive? Or you're saying that when the parents pass away, the policy can be designed in a way where the children won't get a lump sum payment, but will have income coming from it over time?
Let me clarify, Yasha. There are two main types of life insurance under the umbrella of life insurance. There's temporary insurance and permanent insurance. And then underneath those umbrellas, there's subcategories that fall underneath them. Under the permanent life insurance umbrella, there's products that are called cash value life insurance products. Under the subcategories of cash value life insurance, usually people are able to fund these accounts so that there's a bucket of money that they could use while they're alive. And they can take an income from it, usually on a tax-free basis. So no questions asked, no qualifications needed to start taking income from this cash value life insurance pool. So Yasha, a lot of people don't know this, but there's only 3 places where you can put your money where you can receive a tax-free income. That is municipal bonds, which haven't been looking very attractive these days.
No.
The Roth, whether it be an IRA or a works retirement account.
That one seems to be more common.
A lot of people have heard of Roth, yes.
Yeah.
And then, of course, there's cash value life insurance. Now, each one, there's different qualifications that you have to meet. With cash value life insurance, you need to be insurable. And during Life Insurance Awareness Month, we're teaching people you can actually get denied life insurance or have a really, really high premium because of how unhealthy or risky you are or how old you are. So if you have a cash value life insurance policy on yourself, for example, I do have a cash value life insurance policy on myself, meaning if something were to happen to me prematurely, my daughter is going to be taken care of because there's going to be a lump sum of money that's available for her in the future. If nothing happens to me, which is the plan, I have this bucket of money that's growing while I'm alive that if my daughter is in good behavior, I will help pay for her college with that money if she decides to go to college. If, for example, she wants to have a big extravagant wedding one day, there'll be money there. If I want to help her out in buying her first home, I can help her there. If something later on in life happens to me, I can actually decide to say, hey, I no longer can take care of this policy myself. My daughter is old enough to be the owner. I'm going to say, here, you be the owner. I'm going senile now, so I'm trusting you with my money. So
you transfer the policy over to her.
Yes, and
you're still the person insured, though.
Yes.
Interesting.
And depending on where I go, say, for example, I want this insurance policy to keep growing, of course. Now she's going to be managing my policy because I'm getting old, and she's a beneficiary anyway. So that chunk of money when I pass will be hers. And if she wants to use the money that's in there while she's alive from the cash value pool, she can use that as well for whatever she needs it for.
And that goes to her tax-free, even the gains?
Dependent on the way she chooses to withdraw.
Mm-hmm. Okay, I see. Very interesting. That is huge. Not a lot of people know that. I didn't even know that. And I'm advocating life insurance all the time to my clients. So you really opened my mind with this. I appreciate that. And going back to what you said, in order to have a policy, you have to be insurable. Mm-hmm. So for parents with minor children, they tend to be younger, not retired adults. They're more likely going to be insurable. They have jobs, they're supporting a family and whatnot. What I want to go to, though, is the next topic is, what about older parents? Or if you are a sandwich generation, so to speak, if you're taking care of your children, but let's say you're also taking care of your grandparents, mm-hmm. Do you get a life insurance policy on yourself with them as the beneficiary? Do you get a cash value policy on their lives? So that way, if they need any money, they can get that cash value tax-free over a certain time. Like, what do you usually say? What do you usually see happening with older adults that need to be insured?
That's a really good question, Yasha. A lot of times people come to us because they're worried about their parents. My parents, let's just say in their 70s, and they're concerned because when their parents' time comes, who's going to have to take care of their final expenses? A lot of people have not heard this term before, and that could be anything from burial, cremation, memorial services, and then it could even go further as what was happening during the final moments. Medical bills. What if they were hospitalized for a couple months? What if they were in a homicide situation or a drunk driving situation, and now there's legal fees that you have to pay to make sure that there's justice? There's a whole bunch of things that could happen in a final expense moment. And a lot of times adult children who have parents who are closer to that age are worried of having to deal with that financial burden if their parents don't have life insurance. Well,
especially if they don't have any other assets of their own and they're like getting Social Security or Medicare or something like that.
It's a huge concern, Yasha. So what happens is people come to us with these elder parents who are probably no longer insurable. The chances are very high of that. Now, if they are insurable and they're at old age, it's a conversation between the children and the siblings or whoever is going to have to take care of that financial burden of what it is they want to do. Do we want to put in this high premium to insure our parents? And that's something where they strategize with the life insurance professionals to see if it's worth the money. If it's not, or if they get denied insurance, there's other opportunities that we do called self-insurance, where we deal with investments and we come up with different strategies of how we're able to create a pool of money to take care of that need, that final expense need. Lastly, one of the greatest risks to anybody's financial plan is an unexpected medical event. So at life insurance companies, you'll often hear long-term care insurance.
Right.
And when you hear about that, a lot of the times it's the adult children who are asking for their parents. Because a lot of the times across cultures, the long-term care plan is their children. You will take care of me when I'm too old and unable to take care of myself. But a lot of the times, especially for this generation, we're working 40 plus hours a week and have families of our own. We would love to be able to make sure our parents have the care that they need. I'd rather be a care manager than the caretaker.
I see. So how is that panning out right now? Do you see a lot of long-term care policies coming out, or is there a point where your parents get too old that they're no longer insurable?
Yeah, quite often it does happen. A lot of the times people wait a little too long and it's too late. The qualifications for life insurance and long-term care are two completely different ways to qualify. And it just really depends on the person's health and risk, which is why oftentimes we say, find out if you're insurable first. And from there, if we're unable to cross that bridge, we'll see what other ways we can bridge that gap.
Nice. And a little bit of what I'm hearing from you is people use life insurance upon the death of a parent or an older loved one to help pay for their funeral expenses, death expenses, any last minute creditors and debts. So do they still use that to pay taxes as well? Or how can they use life insurance to like handle those kinds of expenses?
Yes, most definitely. Well, Yasha, I'm going to answer your question with asking you a question. How often will come to you, or what is like, do you see like an average estate tax that needs to be paid out that a lot of people were not expecting?
It can happen, especially here in the Bay Area. Not in this day and age, but just like a little over 10 years ago, it was happening. I think back in 2006, when the estate tax was at 40%, the estate tax, for those who don't know, is the death tax that we have in this country. So when you die, the federal government takes the total value of your estate, your net worth essentially, and they say if it is over this certain amount, this freebie amount, so to speak, then you pay 40% of anything over that amount. So back in, I think it was 2004 or 2006, the estate tax freebie amount was just $1 million. And anyone that had more than that had to pay 40% on their net worth. How the family would pay that, and obviously you pass away, so you're not paying it. Your family has to pay it, and they have to find it among all your estates that calculated to that high net worth. So houses will get sold, especially if you don't have an estate plan set up. You got to pull money out of wherever you can, give it to the government before it can go to anyone else. So we actually see this happening with Aretha Franklin right now. She had passed away. She had about a $400 million estate, and she did not have an estate plan. So currently, the estate tax freebie amount under Donald Trump's regime is going to be $11.4 million. That's a rough number. Don't quote me on that. And she had a $400 million estate. So anything above $386 million is about to be taxed right now by the IRS at a rate of 40%. That means the IRS is going to have at least $120,000 to $180,000 paid to them in taxes out of her estate. Where that's coming from, I have no idea.
She's helping out our
So
so I don't know if that's a silver lining.
so if anyone's going to learn something from this, first, the estate tax is 100% voluntary. And from what I'm hearing, you're saying, Christina, is one way that we handle the estate tax, especially if you're a joint couple married, is we create a trust and we separate things out of the trust. We do some advanced planning if you're at like Aretha Franklin status, where you need to push some assets out of your estate, but still have control and protection. That is a little bit more advanced, a little costly. Another option, if you're at that borderline from what I'm hearing you say, is you could create your estate plan. You can use your freebie amount that the government gives you. This is an amount, as we've learned, is fluctuating roughly every 3 years. And then you can get a life insurance policy to pay, where the death benefit comes to the family to pay those taxes.
Exactly.
Yeah. So
often here in the Silicon Valley, that is a topic that a lot of people are asking about. There are a lot of high income earners, especially young ones here in the Silicon Valley, who are very concerned about that. So a lot of the time when it comes to being able to pay taxes and not having to liquidate assets, like you were just saying, having to sell off homes. I mean, you wouldn't want to sell off your home if the housing market
God, no.
out.
Yeah.
You don't want to liquidate.
Not in this economy. Right?
Exactly. But if you have a life insurance policy, that's earmarked specifically for those things. So that when all those other assets that you put in your financial portfolio that are earmarked for retirement, your children's education, or whatever the case may be, get to stay there in your financial portfolio for those purposes.
And the cost, pennies to the dollar.
Pennies
Instead of paying full dollar to the government, you pay a little bit of money for a large policy. Is that roughly the case? Yeah.
Is what it is.
Fantastic. So Christina, before we wrap up, I have one more question for you.
Sure.
I have had situations where I have mom and dad have passed away, brother and sister are inheriting the primary residence. And the way they did their estate plan, the primary residence has to go out equally to them, 50-50. And all of a sudden you see brother and sister as joint tenants. Mm-hmm. And the moment, especially here in California, when sister wants to give her share to brother or brother his share to sister, the property is getting reassessed for property taxes. Yes. And that really sucks. And they don't get a cost basis step up or anything like that. And I've heard that there's a way we can use life insurance to prevent that from happening, where, for instance, sister gets her fair share out of the death benefit of the life insurance policy, and then the full home goes directly to son. So there's no transfer after the estate is kind of closed and cleaned up. And there's no property tax reassessment as a result of that. It's all actually tax-free. How does that work?
That's a great question, Yasha. So a lot of the time when that type of situation happens, the two siblings, there was two, right? Two siblings are now pretty much co-owners with equal ownership of a business, and the business being now the property, where now the equity that is growing inside of this home is their profits from the business. Now, if they don't want to sell off their portion because they like the way the house equity is appreciating and they want to continue this and have it maybe earmarked for something in their future, what oftentimes business owners who are sharing equal partnership in a business do, so in this case, owning the home, they get a life insurance policy on each other for the same amount that they own that share of the property or the business. So if it's 50-50 ownership, they're going to split the life insurance amount on each other of whatever the business valuation is or whatever they think the house is worth, so that if one of them were to pass away, the life insurance benefit's going to go to each other as beneficiaries.
Interesting. That's really cool. So yeah, as you can see, as you know, obviously, there are so many ways that we can use insurance as a strategy or a financial tool for a family. And I've only touched on just the top, and I've learned some stuff from you too. So that's pretty amazing. Thank you very much. Christina, this is all really great. And I know I said that I was going to ask you one final question, but I have one bonus question for you. Okay. I just read a Forbes article all about the rich person's Roth, and something about there's young people who they've accelerated in their careers. They have a great income, especially out here in the Bay Area, Silicon Valley, and they can no longer qualify to set up a Roth IRA or a Roth 401k because they've hit those income limits. And so now that's one less, as you said, one less bucket of tax-free investment that they can make. So what is this rich person Roth? How does that work?
So right now, Yasha, a lot of people, especially here in the Silicon Valley, there's a lot of young individuals who are high income earners and no longer qualify for the Roth.
Right.
And when they no longer qualify for the Roth, that being one of the 3 places where you can get a tax-free income in retirement, that doesn't feel very good. So
not at all.
A lot of the one strategy to get around that, if they're healthy and young and qualify for life insurance, utilizing cash value life insurance as a way to supplement their retirement income in the future, creates something called a buffer asset in retirement. A lot of people are not familiar with the term buffer asset. It's a non-correlated asset, so it's not tied to the market. So that if 2008 happens again on the year this individual retires, let's say they're projected to retire that year, and they're that person that was supposed to retire in 2008 and the market just tanked and all of their assets were correlated into the market. Now they have a couple options. One, sell low, so retire anyway and have that money run out within 5 to 7 years of being retired and have to go back to work or look for new money. Or continue to work, extend their working years, retire 5 to 7 years later to allow their 401k to recover as the market recovers.
And that sucks. More work.
Especially if you're 65 years old, you're like, how much time do I have left on this earth? And I have to work another 5, 7, or maybe even 10 years, depending on how much money you were thinking you need. Now, this individual had a buffer asset where now that this money has been growing, and you can take money out tax-free. It's not tied to the market. 2008 happens, the market tanks. That's okay. I'm still retiring on my scheduled retirement date because I'm going to utilize an income from my buffer asset, and I'm going to turn that income off as soon as my accounts are made whole again. Now that my accounts are made whole again, I'm going to start to take that money from my qualified retirement accounts, and I'm good. I retired on time. I allowed my accounts to recoup, and I was able to take that income, and I was able to live out my retirement happily. And that's something that a lot of people are looking at doing right now. And what that also does, it diversifies their retirement portfolio so that not all their eggs are in one basket meaning pay taxes later during retirement. They've created a bucket of money where they have already paid taxes on their today earning dollars. And taxes is a whole nother thing that I'm sure you're going to want to talk more about too, Yasha, on your show about where taxes are possibly going to go and how that's going to affect you during retirement. But one of the solutions people utilize, life insurance.
So that cash value that they're building up as they pay the premiums is growing into that buffer asset, you're saying, correct?
Correct.
Okay. And then, so compared to a Roth, the advantage, it's like a retirement account. You put your post-tax dollars in, it can grow with the market, your gains and whatever comes out at retirement comes out tax-free. So how does the cash value grow in life insurance if it's not correlated with the market?
Well, there's different types of cash value life insurance, Yasha. You can actually have a plan that is correlated to the market, but there are some plans that are not. So like I said, under the umbrella of permanent life insurance, there's so many that you can choose from. And dependent on what your financial situation is and what your current financial portfolio looks like is how your life insurance professional is going to help guide you on which plan is suitable for your needs. A lot of the time people call this cash value life insurance or this buffer asset the rich person's Roth. You might have read an article before from Forbes. Forbes actually called cash value life insurance the rich person's Roth. So you can't qualify for Roth, that's fine. If you're young and insurable, let's look at cash value life insurance.
All right, everybody. That was just the tip of the iceberg of what happens when you talk about life insurance. There are so many strategies that you can employ. you never know when it can really become an advantage to yourself and your loved ones. I've learned new things today. Christina Mendoza from New York Life, thank you so much for your time. If someone has any follow-up question or wants to learn more about what you're saying, how do they get in touch with you?
Thanks, Yasha. Well, the beauty of the technology that we have today, I've been doing all of my meetings because of COVID and social distancing via Zoom. So you guys can reach me by phone number or email, which we'll have provided. And I'll be happy to answer any questions that you may have. And something that I definitely want to highlight, there are no dumb questions, especially when it comes to life insurance and finances. So feel free to ask whatever questions that you may have, and I'll be happy to get back to you.
I can totally attest to that. Thank you very much, Christina. We're definitely going to have you on. I know I'm going to get a lot of questions from my own viewers and my clients that are watching this. So I think we have a little bit more to talk about in the months to come.
Awesome. Thank you, Yasha.
Thank you. All right, everyone. Thank you all for joining us today on Money Law. My name is Yasha Saba. Remember to subscribe at the bottom of the YouTube video or follow me on LinkedIn, where I post more videos and information. And you can also find Christina on LinkedIn as well if you'd like to connect with her and ask some connections through there. Remember, is it your money or theirs?